What if I told you that March 1st is not just another routine payment date, but a turning point that quietly reshapes how your Social Security income flows for the rest of this year? Not a rumor, not political noise, not speculation, confirmed changes that are already active. And whether those changes strengthen your monthly income or quietly chip away at it depends entirely on how well you understand them. I'm Sara, and today we're going to walk through this intelligently, calmly, and thoroughly, because Social Security is not background noise. It is the foundation of retirement income for millions of Americans. And when that foundation shifts, even slightly, it deserves your full attention. Let's begin with the most widely discussed piece, the 2.5% cost of living adjustment, or COLA. Every year, the Social Security Administration adjusts benefits based on inflation data. The purpose is simple. In theory, if prices rise, your benefit should rise too. For 2025, the official COLA was set at 2.5%. As of your March payment cycle, that increase is fully integrated into your benefit calculation. Now let's translate that into practical numbers. If you receive $2,000 per month, a 2.5% adjustment adds approximately $50 monthly, about $600 per year. For married couples, both receiving benefits, that could mean roughly $1,200 more annually. That may not feel dramatic in a world of rising grocery bills and utility costs, but remember, this is guaranteed, inflation-adjusted income. It compounds year after year because each future increase builds on this higher base. However, here is where clarity becomes essential. The COLA applies to your gross benefit, not the amount that actually lands in your bank account. Most retirees have Medicare Part B premiums automatically deducted before the deposit reaches them. For 2025, the standard Part B premium increased to $185 per month. So if your gross benefit rose by $50, but your Medicare deduction rose by roughly $10, your net increase may feel closer to $40. Still positive, but smaller than expected. And for some retirees, the situation is more layered. If your income from 2 years ago exceeded certain thresholds, you may be paying IRMAA, the income-related monthly adjustment amount. This is an additional surcharge applied to Medicare Part B and Part D premiums. Depending on income level, that surcharge can add hundreds of dollars per month to your deduction. Here's what many retirees don't realize. IRMAA is based on income from 2 years prior. If your income has since declined due to retirement, loss of a spouse, business closure, or other life-changing events, you may qualify for a reduced premium. But that reduction is not automatic. You must file Form SSA 44 to request reconsideration based on a life-changing event. For some retirees, this appeal can restore hundreds of dollars per month. That's not minor. That's thousands of dollars per year. Now, let's shift to what may be the most structurally significant development affecting a specific group of Americans: the elimination of the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. For decades, these rules reduced benefits for certain public sector workers, teachers, firefighters, police officers, and others who earned pensions from employment not covered by Social Security taxes. Under WEP, Social Security benefits were reduced if you also received a pension from non-covered employment. Under GPO, spousal and survivor benefits could be significantly reduced, sometimes eliminated entirely, if you also received a government pension. For millions, these provisions felt punitive. Now, with the passage of the Social Security Fairness Act, both WEP and GPO have been eliminated. That means affected benefits are being recalculated. Approximately 3.2 million Americans may see increases. In some cases, retroactive payments may apply. If you worked in public service and previously experienced a reduction under WEP or GPO, do not assume everything has corrected itself perfectly. Verify. Contact Social Security. Confirm your recalculated amount. Ask whether retroactive adjustments apply to you. Yes, hold times can test patience, but if you are owed increased benefits, that diligence matters. Now let's discuss working retirees, a group that often misunderstands how earnings limits interact with benefits. If you collect Social Security before reaching full retirement age, there is an earnings limit. For 2025, if you're under full retirement age for the entire year, you may earn up to $22,320 without benefit reduction. Earnings above that threshold result in $1 withheld for every $2 earned over the limit. If you reach full retirement age during the year, the threshold increases to $59,520 with $1 withheld for every $3 above that amount until your birthday month. After full retirement age, the earnings limit disappears. Now here's the nuance. Withheld benefits are not permanently lost. Once you reach full retirement age, your monthly benefit is recalculated upward to account for previously withheld months. However, while the long-term math balances out, short-term cash flow can be disrupted. If several checks are withheld unexpectedly, your monthly budget can tighten quickly. This is why precision matters. Run the numbers. Project your earnings carefully. And while we're discussing layered complexity, we must address taxation. Social Security benefits can be taxable depending on combined income. If your combined income exceeds $25,000 as an individual or $32,000 as a married couple filing jointly, up to 50% of benefits may be taxable. Above $34,000 and $44,000 respectively, up to 85% may be taxable. An increase in benefits, whether from COLA or WEP GPO elimination, can raise your combined income. That does not automatically create a crisis, but it may require adjusting withholding now rather than facing a surprise in April. You can request voluntary withholding from Social Security payments or coordinate with other retirement income sources. Planning prevents stress. Finally, there is one action every retiree should complete this month. Review your earnings record. Your Social Security benefit is calculated using your highest 35 years of earnings. If 1 year is missing or incorrectly recorded as 0, it lowers your lifetime average permanently. Errors are not common, but they do occur. A $50 monthly error equals $600 annually. Over 20 years of retirement, that becomes $12,000. Log into your My Social Security account, review each year carefully. If something looks wrong, initiate correction with documentation. Now let's step back and view the full picture. March 1st is not one isolated change. It is a convergence of confirmed adjustments, a 2.5% COLA integrated into benefits, higher Medicare premiums, IRMAA surcharges that may be appealable, elimination of WEP and GPO for affected public servants, earnings limits impacting working retirees, tax thresholds that may shift, the ongoing importance of verifying your earnings history. Individually, each item may seem manageable. Together, they create a system where attention equals financial stability. The retirees who navigate the system confidently are not necessarily the wealthiest. They are the most engaged. They review, they verify, they question, they adjust. You funded this program for decades through FICA contributions. Every paycheck built your future benefit. Leaving money unclaimed, overlooking a reduction you can appeal, or ignoring a recalculation you deserve is not simply administrative oversight, it is forfeiting income you earned. March 1st represents confirmation, not chaos, but confirmation requires attention. Take 30 focused minutes this week. Check your deposit, review deductions, confirm recalculations, examine your earnings record, evaluate tax exposure, Small, deliberate actions today prevent long-term erosion tomorrow. Retirement income is about stability. Stability comes from clarity. Clarity comes from engagement. And now you know exactly where to look and exactly what to verify to ensure you are receiving every dollar you worked a lifetime to earn.